That was the only one you took?
Yeah, for the weekly one shot.
All right, cool. All right, so we're just gonna pick up where we left off last night. And if you haven't seen that recording, it's on the YouTube. Or if you weren't here, you can watch that on YouTube. So last night we were looking at AU delivery. Don't think Surrey is here tonight, but he was the one that picked AU. So because I trade AU and he trades AU, we decided to review AU. So in last night's video, if you remember, we're talking about, well, everything here is from the daily chart. We're talking about this fair value gap, this level in particular, and the fact that if we got here, we're expecting resistance broken become support idea in this context because of how price was delivered here. So let's drop to a lower time frame. It was the 16th. So let's go midnight here. And I'll use that New York time so it's not throw anybody off. That engine on the bullish. Oh yeah. Good stuff. It was good stuff, right? It was good stuff to see it play out. It's even better to anticipate that it was going to form and then take it. So let's zoom in. So last night we were here, and that's why this line is here. This line is where we expected the whole support. And I was saying, if we broke through here, there's nothing stopping this from running higher in this delivery. I didn't see anything that was stopping it. So all of these highs would become likely suspects. All right. Now, I want you to focus on how this happened. I don't want you to just look at it and say, hey, they do what I predicted. That's not what I'm trying to do here. I'm trying to show you something. This run higher is something that we anticipated last night. Looking at the price action now, we can see how it happened, and hopefully that can show us some insights as to what are some of the things that we can expect from a price delivery when we have a bias. So I'm going to stick to our hourly chart for a second, and I want you to look at this side of the delivery. We had that bullish movement straight out of go ahead and mute everyone. We had that bullish move straight out of last night, straight out of midnight New York. It ran to that level that we talked about, then it created a down candle. All right. Now, if we were already expecting resistance broken become support idea, and then price trades up to that quote unquote resistance level, and it creates a down candle, you already have a bias, and now you're seeing market structure that supports your bias. So the first thing you could do is to wait for price to start trading higher here, or you drop to a lower time frame and you start looking for that lower time frame breaking market structure or stuff like that. Now, how this market was delivered is, again, the down candle was there, and then all of this just set up that run higher. This wick that went all the way down here, take this line off now since we know what that line is for, specifically on this candle. We have, I think this is rule number 6 for the persons. I think I did share that in the public channel. This is rule number 6, which specifically says that if a high is broken and price creates a down candle, you stock your entries in the fair value gap that's below this down candle. All right. If you've been here for some time now, then you would see that day when I shared that. And if you're a part of the guys who are doing that the 1v1, then you know exactly what I'm talking about. So now this becomes context that this fair value gap, we could trade back into it, but you don't want to see price closing below the fair value gap here, or that would invalidate your bias, right? So this was all manipulation, clearly, because you can see how the bodies of the candle are all the way up here above this fair value gap. But then that wick came all the way down here. And when you get to a lower time frame, you'll see, I think there's an order block from London that it actually traded back to and then made that push. All right. So if you were, or if you took my advice and believed that this was going to be bullish, then you could have identified all the areas from over here, this side of the curve, that are likely imbalanced, and you could identify where you think price is likely to trade to. All of these old highs, imbalances, all of them would be on the menu. Starting from the one above here, because that's where we want to see price break for validation of a continuation higher. When price gets here, we're not looking at this as a bearish order block that price should stop at. All right. Everything here, we're looking at these as potential areas of sell side liquidity, or well, buy side liquidity that a price should take out. So I'm gonna go to a 5-minute chart because I like a 5-minute chart. Let's just do a quick, where are we? Here. So again, at midnight, we're looking for anything that would support our bias to go long. Price starts trading higher. If you're looking at stuff like previous day highs, previous day lows, it would have been here. It's a lot of stuff now on the chart, but hey, why not? Let's make it thicker. I think somebody's in the chat. Daily opening price. Yeah. Good stuff. So that would have been previous day's highs. I don't know why this is. So I don't like trading view. Too wild. Now clone this and it's not behaving. Am I doing something wrong? I don't think so. Control, click. No. Okay, click and then control. Anyway, I'll just do it manually then. When price opening discount or premium end of a range and how to trade, identify New York, Judo swing. Okay, take a look at that in a second. So I think this is the previous day's highs and lows. If I didn't draw it correctly, then when you're doing your own analysis, you could draw it correctly. So this would have been the range, and you're looking at price expanding above here. Once you get that expansion that breaks above the high, which would have been, sorry, it's kind of a little bit small here, my bad. We're looking for the run that breaks the high. So if you look at right here, all of this run up is the run that breaks the high. So if you're bullish, where is the order block that you'd be looking for price to trade back to give you an entry, assuming you miss this? If you take a look at everything in here, this is the obvious order block. Most persons are going to be looking all over the place with unrealistic targets. Is art fractals with a Judas? I'm not sure what that question means, but this order block just stands out as the start of the run higher that breaks all its market structure. So if you identify that order block, every low that price creates until it trades back to this order block is going to be a storehouse for liquidity. Meaning, if you're going short, you could exit at these lows, or you could simply wait for the buy and buy at order block. No, I don't use SMT, sorry. I don't use it at all. I don't even consider it in anything I do. But As the day progressed, we need New York open. New York open is 7 a.m., which is right there. So again, New York opens and we have the range created from the midnight open to New York. Prices opening deep in the discount end of the range. So I think this was when I shared that my bias is going short. All right. My bias is going short, but you still need to find entry confluences to go short. The entry confluence I use is the same model that I've shared before. The only thing different about it is it was applied to lower time frames for more precision. So if you remember the model, I'm just gonna
Hold on,
generate.
Keith.
Yeah.
You said AU open in deep what? Premium?
Yeah.
Of which range? Can you show at that range, please?
Sure. One sec. Get this off here. So when New York opens right here, the price action or the data that we have available is here to here and London and Asian session if you're factoring Asian session as well. All right, but primarily I'm looking at the range of today to be midnight open to New York open. This range right here. So if you put a fib from here to here, the opening is deep discount, deep premium. Why do I keep saying that? Deep premium, which means that if you're bullish, there's no bullish setup here. Even if you get something, you might get something, but it's very risky to be trading up here for a buy. The ideal entries should form after you get a bearish breaking market structure, and then you have all these lows that you can target. In particular, again, this is that range for the visual persons. That would have been the range right there. So we have 50% right here, which is discount. Right at discount, we have a low, which tells us that there's liquidity resting down here. So when you're looking at the price action like this and you have liquidity resting in discount and the market is opening in premium, if you're bearish, you're targeting the liquidity pool in the discount end of the range. If you're bullish, you're waiting for this liquidity to be taken so you can trade counter to that setup. So you're buying sell stops, selling buy stops, that idea. So if you look at this delivery here and you're waiting for an entry, you would be waiting for price to take buy side liquidity and break market structure for you to get in. So you could zoom out like this and you could see how these levels were those buy side liquidity levels that we marked out when we're on the daily chart, well, the hourly chart really. You could see where those buy side liquidity rest and how we traded into them right here. So if this is the highest point, or could be the lowest depending on what side of the delivery on, but this is our buy side liquidity run. If this is the highest buy side liquidity run, you're looking at what was the range that was created before price made this run. All right, because that's the range that was stop hunt, that was the range that was housing liquidity. Meaning, let's start with the small trend line thing in my jiggy. This is the stop hunt. You're looking for the next lower high before the stop hunt, which is here. Bodies or wicks, your choice. So if this is the stop hunt and this is the high of the range that was the stop hunt happen. What's this? Okay, cool. So if this is the high of the range, you're looking for the low of the range. If this is the high and then that was taken there, this right here is the low of the range. I'm just going to use this wick right here because it's the lowest one. Pull it out, keep the line straight, like so, like that. So this becomes your range, right? High of the range, low of the range. The range was taken right here as a stop point. So now if you trade using that model I've shared before, you'd be waiting for price to trade back inside here above this red line to go short, which means once this down candle closed and we're coming back up above the red line here, you're interested in going short. You can now use whatever precision filter you want. Moving average crossover, RSI, SMT, whatever you want to use. You want to see them support your idea that you want to go short now, right? Because you've already seen the stop point. You've seen that, let's say, breaking market structure. So now you're looking for that retracement to fade it and go short. So this is an entry. Every time price touches this red line, after this down candle closes, that's an entry. You consider yourself wrong about the setup if price is going above this high. So if you're entering here, your stop loss is above here. There are many ways that you can filter out this to make it a much more precise entry, but that's not really why we're here right now. So let's focus on what happened. So we have the range right here. We have that break below the range, price trades up, gives you an entry. This is that dealing range that we're looking at before New York. 50% of the range is right here. This is the order block that started that push, that broke market structure. Liquidity resting below the lows, right? Everything is in here. So that's your target. You don't have to aim for exactly the order block, but you want to at least be looking for this to get taken out, because that's an obvious sell side liquidity pool. We have the dealing range. We have lows in the discount end of the dealing range. So liquidity is resting down here. Can you show an entry model for those that don't know? Which one? The zoom model. I think everybody here probably knows the zoom model by now. I think we mentioned it quite a lot, but if you don't, then you want to have a range like that. Want to see buy side liquidity taken, sell side liquidity taken. Then when it comes back inside your range, you're looking for your entries to go short. So that's the model. So that's what we have right here. This price staying inside here is one of those cruel forms of manipulations that I will not discuss here. So why was the gap left open? Which one? This one right here? Why this gap was left open? Okay, so if I recognize your name correctly, I think we had a chat this weekend. So let's add a little bit of precision filter here. So I'm going to point to a couple of things. The first thing is that this is the range in here. So let's look at this bit of price action right there as the range. Let's just extend it over. Now, under normal circumstances, if price breaks below the range low, you're looking at inside this box for confluence to use and enter, right? Specifically inside this box. There are times when, based on how this delivery was done, the stop onto the high, there are elements in there that would tell you to wait for a deeper run. Don't sell here, wait for an entry here, or wait for a deeper run up here. All right. In this delivery here, there are two things I'm going to point to. The first one, the person who asked the question, I'm going to highlight that candle right there. This candle here does two things. One, it tells you that your entry is going to form here. And two, it tells you that you don't want to see a deep run above this red line because of this specific candle. And again, person who asks a question should know why. The next thing that you can look at here is cool. Next thing you can look at right here is this entire delivery from this candle higher is a series of consecutive up candles or consecutive green candles. So 5, 10, 15, 20. If we're looking at a 20-minute chart or maybe a 15-minute chart, you could, let's go 15 minutes, just because you could identify those candles as one specific order block. Here we are. So on a 15-minute chart, all of the candles that we're looking at just now, they disappear inside this fractal. And now when you can see this fractal, I don't have to explain this anymore, right? This doesn't need explanation. So on a 15-minute chart, you can see this, but on a 5-minute chart, it doesn't look like that. It looks like something else. That's one. Next thing is, let's just make this neat and pretty right there. Next thing is this delivery right here is very familiar to something that we're looking at last night. Try to get a little bit crowded now. I don't want that. I'm gonna take this off. So take a look at this price action inside here on the 4-hour chart. I'm gonna clear them all off because it's getting a little bit crowded, naked charts. And let's just forget about everything over the right side for a second and look at what we're looking at last night. So last night we specifically highlighted this down candle right there as the area that if price gets above here, there is nothing stopping price from going higher. Now, in that video, I didn't speak much on why I say that. So now I'm gonna, as vaguely as I can and leave you guys to study, highlight this specific candle. Take a look at this delivery, all right? We have a delivery of price, small fair value gap, and then this candle with this structure inside here. Now when I go to a 5-minute chart, skedaddle back over to where that entry was formed. I want to look at this right here. And in particular, take a look at this candle. Let's make it nice and pretty. There. That candle right there. Now, in hindsight, I want you to look at how price reacted once we close below the low of this candle. Right here, we had wicks going below, showing that there is, can you shift when during trend line? Oh yeah. Old habits. We have wicks going here that shows us that there is interest in going lower, but there is no confirmation yet. Confirmation comes when we have price closing below that low. All right. We close below it right here with this down candle. Once this candle closes right here, this entire range should be a wall, brick wall, which means that resistance broken becomes support, support broken becomes resistance, depending on the context, will work right here. So again, if we go back to the 4-hour chart, you look at that structure right there. No, it's not a breaker block. This is why I said last night that if we broke above this area in here, so resistance becomes support idea is very likely to work. It's in the video last night and it's in the recording on YouTube. That's why I was saying that, because of how this structure was. So on a 5-minute chart, when I saw that form, I shorted AU here and I held it until somewhere in here. And then I closed. Somewhere in here I closed. I didn't hold it all the way down, but I bought the low. So I sold up here and I bought the low. This, everything I'm showing you right now is the context for why I took those trades. Why I said that last night and why I shared the actual trades I took so that you could see what I was saying play out. Not to like show a chart, just to show an entry. I explained why it would likely happen and then I showed you it happening. So this candle right here in the middle is context that once we break below here, we are not going to get a deeper run. So any fair value gaps, anything up here will likely stay open. If they don't stay open, it's going to be wild where the bodies are down here and the wicks come back just to manipulate or take persons out. But on a directional bias basis, we would be bearish. No, that's not a breakout. That's not a breakout. My bad. Sorry. So this set up that run to go down here. We already had a reason to want price to go down here. The range equilibrium was down there. So you want to see premium to discount, discount to premium, that type of market structure. So it's pretty simple when you look at it like that. It tells you when you can likely expect a Judas and when you should just don't do anything, or when you should just take a trade immediately. So if we jump over to NAS for a second, I was talking to somebody in the chat this week when I said that NAS is going to run sell side liquidity and then go to 14K this week. See what happens here? So even though it happened today, all throughout the week, I was selling every time. Why do you like AU instead of EU? Is it because AU correlates with gold? EU is the most manipulated forex pair. EU is the most manipulated forex pair. So because of that, it makes algorithmic principles work. What I don't like about EU is that it has times when it behaves like GJ. You'll get a really good entry, but price will still stay like this and potentially stop you out before you get a good move. So I can trade EU, but AU is less manipulated for me. There are lots of confidence that you can use to trade EU and GU, but at the end of the day, it's what suits my model the most that I'll stick to. So if you look at this fractal, let's look at this fractal for a second without any time filters. If anyone asks you to identify where the draw on liquidity was before this big run, it would be this low and inside here. Now, if we factor in previous day and we look at any runs, it's kind of looking a little bit small now. Any price run that broke market structure, I want to highlight this one in particular in hindsight. I want to highlight where it broke above. So it broke above right there. So we have a price run right here that broke above a high. The order block that started that push is this. So rule number one, all order block candidates must break market structure. So I have an order block that broke market structure right here. All right. So this is by definition a high probability order block. Now, if we put in the time element, unclick auto, no idea what you're talking about. No idea at all. Start of the day over here. This won't behave. There we go. Oh, all right. And then if we find 7 a.m., which is right here, take a look at that range. It's going to look pretty much the same like AU. Grab a quick fib here, there. This is the range, right? Put in a line at midpoint of the range right there. I take off this fib now. We have New York opening up here, which is in the premium end of this range, which means stock short setups or wait for price to trade the discount.
Kish, can you put back the fib, please?
Sure. From here, there we go. There
Why
we go.
that swing? Why that swing line, not the one before it?
Which one? Here?
Yeah, why not the one before it?
My bad. That should have been the one.
Okay.
Because we're looking at the range from midnight to New York open. So it's always the lowest low and the highest high before 7 a.m. Right in there. So let me just adjust my equilibrium. So you're looking for buys below here. So if you're already looking for buys below here, all you have to do is focus on this price action. Where are your discount arrays inside here, instead of looking at every order block or every down candles in this entire swing? You can now refine your focus to just inside here. And then this would stand out. Even if the order block doesn't stand out, we have consecutive up close candles right here, which makes this ICT's buy side imbalance, sell side inefficiency. So all of this becomes a target. So you either stock shorts or you look for buys. You know, I was being me, so I sold. I don't remember where I sold this. I don't remember, honestly. It was a 1 minute chart. I sold somewhere on this, and then I bought. I don't think I bought the exact low. No, I didn't buy this. I bought AU. My bad, sorry. But for the guys who know the rules I use for entry, we will be going long in this green candle right here. When this candle closed, based on rule number 2, we'd be buying in this, no fear. And then once you're buying this deep, and we already outlined that the target would be 14K, then it becomes a waiting game if you're strong enough to hold it. Then 14K would have delivered perfectly. So when you're buying the next candle, how do you measure your SL? So the easiest thing to use to measure when you framing your stop loss is market structure. All right. So if when this candle closes, the down candle right here, you're buying into the next up candle, where do you consider yourself invalidated, or where do you consider the setup wrong? Below the order block. Right. So you're buying. So let's say you bought exactly at the opening price of this candle. You'd still have your stop loss below here. If in terms of points that's too far for you, then you fade the candle. Meaning when we open here and it's trading lower, you buy into that at the order block, because this candle would have closed here and then the order block is down here. Confluence is right here. So you're looking at a really almost unrealistic stop loss. Then you buy it and then you just watch it play out. Candle snaps back immediately. By the time this candle right here closed, you would have been so comfortably in this position, you're very likely to move your stop to break even and then watch it play out. So at this point in time, it's no longer about managing risk. Once you get this candle close, you're now looking at what you want to see to continue holding this trade. And I think that's a mistake most persons make. When you take a position, if you look at the profit and loss that you're making, it's likely you're going to be, just focus on the money and the numbers. But if you focus on the price action and the chart after you get involved, you start watching the price delivery, and then you start deciding, what do I want to see to continue to hold this trade? If I'm bullish, I want to see highs being broken. This is the first high. I want to see price close above here. I don't care if it retraces in here. It doesn't matter to me. All I'm looking at is, how is the candles closing? Is it closing above here or not? Then I want to see it expand to this. It takes here. Hey, LeSean.
Yeah, I believe this is my first time witnessing this, but do you need a higher time frame? What's just a narrative to use this model in terms of using London's premium and discount to trade New York?
So if I'm being completely honest, you don't need a higher time frame narrative for anything at all. But having a higher time frame narrative makes your trading easier, in the sense that if the higher time frame is bullish and you see the market run into discount or taking out sell side liquidity, you feel more comfortable buying into those. But remember, if you remember that small thing that we started in the group where I was showing you how to trade without a bias, there are a couple of rules that you employ to trade without a bias, and then this is one of them. So when you trade like this, you're specifically trading the price delivery as it forms on a chart. You start thinking about what you want to see, and if you don't see that, you either take partials or you close the trade. But we have less than a minute now. The Zoom is about to end. Hopefully this continuation helps to make things clear from last night. All right, enjoy the rest of your night, guys.